Today, we're diving into the latest report from Figtree Holdings. And let me tell you, it is a real page-turner, and not in a good way. We're going to break down exactly what's going on, why you should care, and what this all means for the company's future.
So have you ever looked at a financial report and just wondered, what am I even supposed to be looking for here? What are the real warning signs that a company might be in trouble? Well, that's exactly what we're going to do today. We're going to use Figtree's report as a live case study, spotting those red flags together as we go.
Okay, here's how we'll break it all down. First, we'll look at the biggest warning sign right up top. Then, we'll dig into the performance numbers, figure out the story behind that massive drop, see where the cash is going, and finally, talk about what might be next for Figtree. Let's get into it.
All right, Section 1, a company under pressure. And sometimes the most alarming signal isn't buried in some complicated spreadsheet. It's right there in plain sight, written in plain English.
And there it is. Seriously, this isn't some analyst on the outside looking in. This comes directly from the company itself. They've put it in writing that there's significant doubt about their ability to continue as a going concern. I mean, wow, that is about as serious as it gets. It's basically the company raising its own hand and saying, hey, just so you know, we might not be around for much longer.
So what on earth is a going concern? Well, think of it like this. It's the basic, fundamental assumption in accounting that a company is healthy enough to keep its doors open for the foreseeable future, right? It's not planning to just pack up and liquidate its assets. So when a company itself questions that, that's a huge deal. It puts a giant asterisk next to every single other number we're about to look at in this report.
And this slide really shows the tightrope they're trying to walk. On one side, you've got the reasons for all this doubt. A net loss of over $3 million, an adjusted deficiency in net current assets, which is just a fancy way of saying their short-term debts are bigger than their short-term assets. Not good. And they're heavily dependent on a shareholder for support. Yikes. But then, on the other side, you have management trying to say, hey, hold on. They point out they still have about $8 million in net current assets on the books, their cash flow forecast looks okay, and they even secured a new loan. It's a real balancing act between some pretty scary facts and management's reassurances.
Okay, so we've heard the official warning. Now let's get into the nitty-gritty. Let's dissect the performance and see the numbers that are setting off all these alarm bells.
Whoa, okay, here's the headline number. A drop in revenue of 75.3%. Let's just let that sink in for a second. That's not a slowdown. That's falling off a cliff. The big question, of course, is how on earth does that even happen? And this bar chart just makes it painfully clear. Look at that. For the first 9 months of 2024, they brought in $7 million. Fast forward a year, same period, just $1.7 million. Seeing it visually like this really hammers home the scale of the problem. This is a massive, massive decline.
So what happens when your revenue collapses like that? Well, this is what happens. A net loss of over $3.1 million. After paying all the bills, all the salaries, everything, they were still deep, deep in the red. It's the natural and pretty brutal consequence of that revenue freefall we just saw.
All right, so we know what happened. Revenue tanked and they lost a ton of money. But now for the interesting part. Why? What's the real story behind these numbers?
So the company actually gives us a pretty straightforward explanation. See, last year, a huge chunk of their money came from one big project called Jaerte. Well, that project's finished. Done. So now in 2025, they're relying on a bunch of smaller projects. And here's the kicker. These smaller gigs also have lower profit margins. So it's a double whammy, right? Not only is there less work, but the work they do have is less profitable. This really shows how risky it can be for a company to rely too heavily on just one or two big contracts.
A bad income statement is one thing, but what does this mean for the actual cash in the bank? It's time to follow the money and see what's really happening to their cash pile and their debt levels.
And yikes, this is where it gets really scary. Look at the left side. Their cash has basically evaporated. They went from $2.2 million in the bank down to just over $400,000 in 9 months. And at the very same time, look at the right. Their total debt went up by $2 million. So cash is getting burned up while debt is piling on. This is the classic textbook definition of a company in serious financial distress. And it all links right back to that going concern warning we started with.
So, we've laid out all the problems. The big question now is, what are they going to do about it? Let's look at their game plan for the road ahead, the challenges they're up against, and the strategies they're hoping will pull them through this.
So the company is pretty honest here. The challenges are huge. A tough global economy, costs are going up, and it's hard to find new projects. And their response? It's all about defense. This isn't a playbook for growth, it's a survival guide. They're talking about strengthening their finances, holding on to every bit of cash they can, and trying to squeeze value out of the assets they already own. Basically, they're in full-on batten down the hatches mode.
And this quote from management really says it all, doesn't it? Cautious outlook, assess market developments, adapt our strategies. This is corporate speak for we're being very, very careful and we're just trying to stay afloat. There are no big, bold promises of a huge turnaround here, just a message of trying to survive these tough times, which is exactly what all the numbers have been telling us.
So it all comes back to this one big question. We've seen the formal significant doubt warning. We've seen the revenue collapse, the cash disappear, and the debt climb. And we've also seen their plan, which is essentially to hang on tight and hope for the best. But is that enough? Can a company that's just playing defense actually turn things around when the pressure is this intense? Honestly, that is the multi-million-dollar question. And you can bet a lot of people will be watching very, very closely to see what happens next.